Hello everybody, it's Bruce Profits back again with another video. This one I believe is the 5th video. It's going to be titled AMD, Accumulation, Manipulation, Distribution. Okay, just to remind you guys, I have 8 years of trading experience, 4 years studying ICT. I'm currently a full-time trader. This is an ICT concept as far as I know. Some people call it Power of 3. Some people call it Accumulation, Manipulation, Distribution, AMD, I believe. So I'm just going to go with it known as AMD. So I'm going to draw an example of it for both buy and sell side. So if you're going to be buying or selling, and I'm going to explain why this is so important. Okay. So the market moves in a format called AMD. So it accumulates, manipulates, and then distributes. For instance, we may have a section of price action that actually shoots up. Sorry, I'm just trying to draw a box. Okay. And then what we'll have after that is, we had an accumulation, manipulation, and then a distribution down. So essentially what you're going to be seeing in order to get it into a trade is a large amount of accumulation. So we're going to see basically price trapped in a box. And then at some point, price is actually going to break in above the box, making retail think there's a breakout. That is known as the manipulation leg. So the accumulation leg typically is going to happen before we're going to get in a trade. We're going to see price accumulating. And then what we're going to be doing is waiting for it to manipulate up, which is going to look like a breakout. And it's going to manipulate into a box like this. And eventually it's going to struggle to stay above 50% of that small manipulation range. Sometimes it may just be, one push. And then eventually that breaks down into what we know as distribution. Now through that, we're able to actually frame multiple trades and take advantage and make money. So I'm going to frame these trades. So the first one up here in the manipulation leg is going to be known as the turtle soup. The second one, once distribution is confirmed, is going to be known as the unicorn. And then the third one is going to be known as the 2022 model, right? That's a fair value gap. Now, the key to these trades are timing. So turtle soup happens in the manipulation. Unicorn happens right at the beginning or within the distribution leg. And then one of the last trades I'm going to be teaching is going to be that 2022 model, which is a fair value gap that happens a little bit after the unicorn model, but it is above the 50% of the entire distribution. So we want to make sure that we're getting in still with room to go down. The initial targets are definitely going to be like the low of the accumulation, plus whatever other lows we can see. Typically, we're going to be targeting another form of consolidation, right? So for the buy side is the exact same way. The turtle soup trade is going to come within the manipulation leg, and that's what I actually made most of my initial money and trades off of, turtle soup. Then I learned about unicorn, which happened in the distribution leg, which is a more confirmed entry. And then the most confirmed entry after all of that would be the would be the 2022 model. So there's going to be 3 models I'm going to be teaching how to catch. The key for all of this is waiting for accumulation. So you're waiting for basically price to range from back and forth and then break out to the upside for the buy side trade. And what we want to see is price actually hit what's known as a higher time frame POI. Let me move these up just to show you guys. Let me show you what they look like. So for instance, what we want to see is price come into a higher time frame point of interest. That's what a POI is. So that would be London high, London low, previous day's high, previous day's low. A 4-hour high, 15-minute high, pretty much relative to whatever time frame you're entering on. We want to see a higher time frame area hit. There's plenty of levels listed, but the main ones you want to think about are going to be session highs and lows, aside from session highs and lows, we want to see daily, weekly, monthly extremes. So that's the highs and lows. And then additionally, you can use like 1 hour, 15-minute highs and lows as well. So there's a large range of highs and lows which you can use. Um, let's put it here. 15 to 4 15 minute, 1 hour, 4 hour. Something's wrong with my number. 4 prints a whole bunch of 4s, so I don't know what's up. But essentially what you're going to be doing is you're going to be looking for one of these key levels to be hit around a specific time, these higher time frame point of interest. And um that typically happens closer to macro times. So what you're going to want to be doing is making sure that you're trading within one of the execution windows. So for me, that's going to be between 10 and 12, right? Or 10 to 11 per se. And then again between 2 to 4 or 2 to 3. So those are the windows I would prefer for everyone to trade, whether that be AM or PM. What you're going to want to see is accumulation before your session, then a manipulation leg that happens at the beginning of your session for you to either enter turtle soup. Then during the session, there'll be distribution trades to catch. Depending on whether it's a sell or a buy leg, it changes as far as reaccumulation and distribution. The terminology does change, but what you want to understand is you're looking for a higher time frame point of interest to initiate the trade, and you're basically just saying, can I get in any one of these 3 different entries? Now there are other entries to think about, but I'm going to be teaching these three entries specifically in individual videos so that everyone can learn how to catch them, so you don't fear missing out on the move and having to do additional um you know gambling practices to get in the trade. We want to be confident knowing where price is going and the potential to get in the trade. So again, this video is called Accumulation, Manipulation, Distribution. The key is looking at how price accumulates, manipulates up, and then distributes down. Multiple entries within that. You can refer to ICT market maker model videos to really learn a lot about this. Accumulation manipulation videos as well. Accumulation manipulation distribution videos as well. But I will be going over all these in separate videos. Thank you. Okay, I'm back. Here's an example of accumulation, manipulation, distribution. This example is for the sell side. So what you got to understand is that time means everything. So just to give you a quick heads up, this distribution happens between 9:35 all the way down to about 10:45. So that's right within our window to catch a trade. Like I said, we want a higher time frame point of interest to be intercepted after accumulation. Okay, so this is a 15-minute point of interest, this blue line. What we had here was accumulation, so we created a range. We broke above that 15-minute point of interest. We had another small teeny range. Then we violated that range. Okay, that's a 5-minute stop hunt. So for a turtle soup, what you're going to be looking for is a higher time frame level to be ran. Then on the lower time frame, another run of liquidity. So the 15-minute point of interest was a run on liquidity of the 15-minute time frame. Potentially also like the hourly time frame. If you look, that level is higher than just 15 minutes. And then for this lower time frame right here, we had a run on a 5-minute time frame. So since we're currently on the 5-minute time frame, this is a run on a 5-minute run on liquidity. This is a stop hunt. So anyone who had stop losses above here trying to sell, their stops were taken out. This is the manipulation leg. So we accumulated, we manipulated above that higher time frame point of interest. Then we took out another form of liquidity in a lower time frame, such as the 5-minute. And at that point, that's when you'd be looking for the turtle soup sell. Now, this is the most aggressive entry. Hypothetically, if you did sell there and you put a stop loss, let's just say hypothetically for about 50 points at the run, you would have been fine. But let's just say hypothetically that first entry you do a little bit loose, maybe about 62 points or 60 points. With one contract, that would be about $120 risk. Again, when you want a lower time frame, you may be able to find a better stop loss, but I'm just trying to frame the overall trade. And we're going to be targeting the equal lows down here, right? Because this is where area of price where there was lows that all lined up. So there's definitely stop loss orders under here. That's what we're targeting. We're targeting liquidity. We're targeting buy stops and sell stops. So we had accumulation. We manipulated up. And then if we were in a turtle soup trade, it would be about 60 pips, 60 points risk for about 251 points. That's a 4-to-1. That's more than enough. You can probably open up your risk just to be safe. Maybe let's say risk $100 at about 100 points for one contract on MNQ. Again, I only trade the micros. The point of this video is just to show you what it looks like on these candles. So the first entry, turtle soup, we see that. I'm going to delete this here. The second entry is going to be right here. This is going to be the unicorn entry. So to get a unicorn entry, what we're going to need is a breaker block, right, and a fair value gap to overlap. Now, a breaker block is a failed order block. So it's an order block that in the past sent price up. So the last time price tapped into this area, relatively speaking, price went up. This is an area where once price came back and retested it changed the state of delivery, right? So you can also label this lower end as a change in state of delivery. That's an advanced concept, CISD. This black line, I'm gonna just label it change in state of delivery so that you're aware. Once you start understanding that, you'll understand that, every breaker has a change of state of delivery. Otherwise, it's just an order block. There was no change of state of delivery. Okay, so on this time frame, 5-minute time frame, what we had was a break below this order block, turning it into a breaker block, right? The last set of down close candles in an uptrend that's broken will become a breaker block. I know there's some red candles up here, but again, on another time frame, this is the main red candle area before this bullish push up that was broken to turn this order block into a breaker block. So I labeled it as breaker, change that to breaker block, just so you know. Now, again, we're going over the framework to frame a trade and all the different possible trades that I'm going to be teaching that are all from ICT. So we need that breaker block. And then over here, as you can see, once we broke down, we're looking for an overlap. So breaker block overlap with a fair value gap. So a fair value gap, all right, is the gap between the previous candle's low and the next candle's high. So technically, this entire area right here is a fair value gap. But I'm not going to be marking up that entire area because I'm looking for the area that overlaps with the breaker block. Okay, that's what I'm looking for a unicorn trade. That's why I only labeled this, because this is the area that overlapped completely with the breaker block and the fair value gap. This is the only area where I'm looking to take a sell trade. Now, this is going to be the unicorn trade right here. Now, I caught this trade during the week by using OTE. That's another entry model. There's plenty of entry models to get in the market, as long as you can understand accumulating, manipulating above a point of interest, right? Looking for liquidity to be ran, letting a turtle soup occur. You don't have to enter on turtle soup. And then after entering on a unicorn, you don't have to enter on unicorn. But then there's that other entry, which I like, which is the fair value gap / silver bullet trade. So what happened is there's another fair value gap here because the low of the candle before it and the high of the candle after it, you can see that they did not intercept. So that's how you determine the fair value gap. Now we'll have another video about fair value gaps independently, but again, for the silver bullet, we're looking for a fair value gap between 10 and 11. So this happened specifically at 9:55. This candle formed the fair value gap. We retested into it at 10:15. And as long as we stay within the fair value gap, we can, use that as a trade. Hypothetically, if we frame the trade for this one, let's just see. Let's say we use the high of the candle that created the fair value gap. We'd have about a 45-point stop. And at the very minimum, we're looking for a 1-to-1. We would easily get that without even taking out this low, right? And if we ended up taking out the equal lows, that's about a 1.4-to-1. So again, everything starts with a 1-to-1. And then let's say we wanted to just target the lows of that recent price action right here, then we could have got a 2-to-1. So as long as you know how to frame the stop loss is going to be the high of the candle that forms a fair value gap, or you can use within that wick above the 50% level, you would have been stopped out here. You can also use the high, the swing high. Again, that would have caused a much larger stop, but you could still have used a 1-to-1 if you had framed that larger stop. Now let's bring this entry back to the unicorn entry. So the reason I like the unicorn is because it's after the confirmation of the turtle soup, but it's before the silver bullet. So there's a lot more room for this trade. Now, as you can see, it pulled back. So it's a trade where you want to kind of take profits. You don't want to just leave it running forever. So if you enter, let's just say at that box at the low, and use your stop above the candle's high that created the fair value gap, which would be this red candle here, that would be about, I'm trying to look at that would be about a 45-point stop. If we just targeted the equal lows, that's about a 2.94 risk reward. So that would be a great trade itself. So we framed three great trades based on accumulation, manipulation, distribution. We accumulated, manipulated above this point of interest. We got that 5-minute stop hunt for the turtle soup entry. Then we broke down. We took out that order block, turning it into a breaker block, and then overlapped with a fair value gap here for a unicorn entry. Once that further broke down, we had another fair value gap for a silver bullet entry, and then that trade would have been great. And once this level's taken out, as you can see, price started trending higher. So this means this bearish PD array became a bullish PD array, and then that allowed for price action to go bullish. But this lesson was simply learning about how we can use accumulation, manipulation, and distribution a little bit better on the sell side.